recorded as well. So the recording has started, and I'm going to go from the beginning. So this is going to be when I say change your mind forever, it's more about reshaping mindset. So it's a bit of a price action slash mindset video, right? The reason I'm doing this specifically is that this week was probably one of the weirdest kind of markets to trade. So if I kind of I mean, I trade ES futures. However, you can break this down for almost any market, right? So let me just get rid of these. So how you want to approach this is very simple, right? You want to try and understand where your highs and lows are. So we have our high, we have our low, and then this is our 50% area. So anything above the 50% becomes premium, anything below becomes discount. Now, I think at this point I've had one-to-one sessions with all of you, so you all understand the basics here. And if anyone joins, I will need to see. So no one's joined. Okay. So typically what I'm looking for now, this is going to be my general bias on yes. So this is not financial advice, this is just my overall bias. So there's a reason I don't like the structural low down here. When I say I don't like the structural low, I've got nothing against it, but it's a case of this is actually the Asian low right here. This is the Asian low. Now, because it's obviously in the Asian session, because it's highlighted in orange. So what I think is going to happen is this is the previous week low or 2 weeks ago low, and it's an Asian low. So I expect lower prices for sure, and I do expect some support to be made, and we're going to be heading back up to these key levels here. So this week the key levels, I mean, they've been there of course, but they've not been super interactive. I mean, Monday, Tuesday, and Wednesday, FOMC. FOMC has created this move down here. So what I'm looking for now is I won't go so much into how I find key levels. I'll go through that in another stream. But here's my key level 1, key level 2, key level 3, and then key level 4. And so your basic job is to understand that you're only allowed to trade at one of these areas. So for example, if we break, I think tomorrow we'll see a break above 1, and then we'll see price get to 2, and then next week, I think only 1 and 2 are is our focus for the rest of the week. Now, I'm going to be looking for key levels below this low. This low has to get swept. I think there's an 80-90% chance this low is going to get swept. And when this low gets swept, we're going to look for demand because we are below the weekly opening price and we've taken out major liquidity. So this is a previous week low. It's also an Asian low. So I'm just going to write AL. It's an Asian low. So we want this to be swept, we want demand to be created, and we want to go long. Does everyone understand that basic premises, how I'm kind of going at? So being I think one of the most powerful skills is being able to sit and plan your days before. It doesn't always have to work out in your favor, but you want to have levels and you want to have an overall bias, which gives you the confidence to go into the next session. So that's kind of everything I wanted to go through on that front. Now, when it comes to the presentation, so let's go to the presentation. Now, I just want to make sure that everyone can kind of see this. So can everyone see where it says change your mind forever, price action labs? Just someone say yes, I can
Yeah,
see. So these are some of the common concepts that you hear, right? So I'm going to be starting off by going over common concepts. And so sweeps of liquidity, we've all heard this concept, right? Market structure shifts, so breaks of structure, candle breaks above. People use market structure shifts either to look at highs and lows, or they use it for their levels, right? Either or, incorrect. Fair value gaps and inverse fair value gaps, support and resistance, which we're going to talk about a lot in this video, and then trend lines. And so what I often say with each of these, there is a fundamental flawed thinking when it comes to using these, right? So with liquidity, liquidity exists everywhere in the market. And so by definition, if you are looking for liquidity, liquidity could exist everywhere. And right now, markets are generating liquidity across Forex, commodities, futures, just about anything. The markets are constantly generating liquidity. So a sweep of liquidity is like looking for a grain of sand at the beach, right? It exists everywhere. So when things exist everywhere, the value of them goes down. And so that translates into your entry model. You want to add things into your system, or you want to add things into your arsenal, you want to add things into your process that has value. Now, if liquidity exists everywhere, there is an oversupply of something. So the price of that will fall theoretically. And what's really going on is if you're looking for sweeps of liquidity, that is not viable. Same thing with market structure shifts, because by definition, you're waiting for a high or low to be broken. Now, the problem with that is that highs and lows are broken everywhere because highs and lows are made everywhere. So sweeps are probably the worst. Market structure shifts are not far off. Same thing with fair value gaps and inverse fair value gaps, right? They exist everywhere, and so you're kind of, it's very much a saturated market, meaning they exist everywhere, and so their value to entry or value for entry is low. What I mean by value for entry is that when you're going to enter the markets, you need to make sure that the system you followed is actually valuable. So I'm just going to be going over what that means. Now we're going to skip support and resistance for a second, but trend lines, I mean, I hope nobody here is drawing them to try and trade, or even trying to, because I can draw a 68-degree trend line and someone else can draw a 62-degree trend line and someone can draw a 58-degree trend line. And so these, I just want you to move away from all of these. Now, when it comes to support and resistance is the most interesting topic because support and resistance is basically how the markets work, or how I like to say demand and supply, or supply and demand, right? A resistance area is really a supply in the market, and a support area is really a demand in the market. And so what you see at the top is an area of resistance, and what you see at the bottom is an area of demand. So hopefully people can see, because you've all had some basic order flow training by now, I think, right? Most of you have. So what you see here is a lot of aggressive buying, and that's where the execution happens, right? This particular day, 7 contracts on MES over here. Now, the aggressive buy orders fail, which creates an oversupply in the market, which then creates resistance. So you want to short. Support is created in the opposite way, where we see aggressive sellers, aggressive sellers, aggressive sellers. We see a lot of aggressive sellers in the market, but they were unable to break below their zone. And so that means that the market is supporting buyers, or there's passive buyers present in the market. And so when I title this presentation as Change Your Mind Forever, I want you to move away from drawing things and putting your own kind of perspective on the market. Instead of looking for key levels and trying to like make your own bounce or theory off them, you want to let the market tell you what it wants to do and just follow that. It's a bit of a mindset shift, right? So trading without order flow, I don't really want anyone to do it moving forward because of these four reasons. So the market is an auction, it's not a show. Supply and demand governs every market. Predicting markets is a bit harsh to say, but gross levels of ego, because none of these things actually help you read markets long term in having a direction. And most important thing, this is the funny thing, right? The market actually tells you what it wants to do, and it leaves plenty of clues. So your job is to read those clues and not make up your own. Okay? Because I made this presentation with a lot of passion, right? So I've directed it at people who shall remain anonymous. No one in this call, but people who shall remain anonymous. I've kind of aimed it at them so they can kind of understand, right? You're at a crossroad. The market leaves clues on what it wants to do. Now, what I mean by that specifically is, let me give you one example of key level selection, because I get this question a lot. Now, this fair value gap was created on the 3rd of March. Okay. Now, this fair value gap was created on the 3rd of March. We actually had price giving us a long here. This was a demand area long, right? Now, what's going on is we saw supply, we saw supply, we saw supply, we saw supply. So this is where sellers are in control, right? S for supply, sellers. Now, when sellers are in control of the market, right, after the demand, right, after this demand gets broken, what we're starting to see here is that the market is giving us clues on where the buyers and sellers are sitting, right? So there's no need for any of you to try and predict lines, draw lines, or use any kind of indicators, VWAPs, or whatever, whatever, whatever. The market tells you what it wants to do. Your job is simply to read it. You pair this with volume, right? So you want to try and, well, let me do this one. So you want to try and understand where the volume is high and low. And what you'll find typically is that you have these high volume areas, right? You have these high volume areas at these key levels. And so key levels are the most important thing. Volume is kind of an add-on to that. So once you have your key levels, you really want to focus on trading at them, right? So this 1, 2, 3, for example, I've shown you how I got 2. It's the basic theory for all the other ones. You need to read the clues of the market and not make up your own. Very important. Now, so the market is an auction, nothing else. So I'm going to be breaking down what this actually means. So I'm going to be also hopping in the Discord because I want to see if there's any new members. No new members, right? So the market is an auction between buyers and sellers, nothing else, right? There is nothing else that comes close. So this was a trade I took last week on, I think Thursday. It was a really hard trade to hold, and this was a trade which took on Friday. So if I just break down what the trade actually looked like, because the trade itself was a really difficult one to kind of stay in long term. but it looks something like this. So I'll try and find that price action because it's quite good price action to at least see, right? So here we go. Here was the trade, right? So this was the trade. So we never actually got to this target, 1350, which was quite a shame. But what you want to understand is that we had the 15-minute orb. So I speak to a lot of traders who try and trade breakouts, orb, etc., etc. That's all good, but you need to understand where the orb is happening. So you can't trade orb in the middle of nowhere. So for example, this was an orb that was in the middle of nowhere, right here. This was an orb that's in the middle of nowhere. Now, in order for this orb to actually be valid, you need to, and I'll show you an example of today actually, right? Because today looks something like this, right? Today looks something like this. The orb was, here, where was it? Here we are. So this was today's price action, right? This was today's PA. And so today's PA was like this, right? So here was the 15-minute orb. For those who trade the orb, 5 minute, 15 minute. What you can see very categorically is that we stayed in this orb for a very long time, which is not the best. In fact, we stayed in even longer. Price came back into the orb, right? So what I'm trying to say, if this is your orb, here's your key level one, here's your key level two. You don't just trade orb for the sake of trading orb, right? That's not how you do it. You want to tap into it. If you want to get the optimal risk to reward and you actually want to do this long term, you want to be tapping into one of the key levels. Very important. One of these two. Now, okay. So where were we? And so if you just take a look at this trade, for example, I don't like the trades where we see an entry and then an exit and then an entry. It was very difficult to hold a trade like this. However, it was a good trade, and I want to go through that. So that's what we saw over here. So that was this trade, and then this was Friday's price action, so right here. So what I want you to take away from this is that when the market shows you that there's supply over here, this is Thursday's trade, I took the short not because I thought the market was going to reject lower. I took the short because I planned my level and I let the market show its hand on what it wanted to do, right? And so what you also want to take away, there's two things you want to take away. The first thing to take away is that the market will tell you what it wants to do, and the second thing is once the market has told you what it wants to do at a particular price, you want to keep referring back to that price. And so that is the theory behind levels. I get this question a lot. That is the basic theory behind levels. So if I show you here on the charts right now, what you can see is this was that Thursday trade right here. This is the one I was talking about. So this was the Thursday trade. Boom, this was the Friday trade, right? So we see an area of supply, we see area of supply. Uh, Even here, to be fair, even on Monday, we couldn't really break out this. So we see an area of supply. So we see supply, supply, supply. So it's the market that shows you the clues. Your job is to, I almost have the humility to read them. I made this presentation aimed at people specifically so they can actually understand how the markets work, right? No flips, no bosses, no chalks, no VWAPs, EMAs, volume profiles are going to help you get through this, right? So it's an iterative process. You put the knowledge in, you try and understand how the knowledge works, and you iterate over time. That's how any skill is developed. I still get my key levels wrong sometimes, right? Not all the time, but sometimes. So the market is an auction because what we had over here is aggressive buying. So I'm going to try and make the chat as interactive as possible because I know some people here do understand order flow. What do I mean by aggressive buying and how does the chart on the left actually show that? Anyone, just unmute yourself. Try not to speak over each other. Anyone?
Hello? Oh,
Yo.
okay.
Yeah, go on.
Where we can see there are passive sellers sitting at that level. You can notice by um, the red deltas, the high red deltas in your candles. I can't really see it properly, Sandeep, but you can see that there's passive sellers sitting at that area or that level, absorbing price action.
Yeah, that's what I meant. I meant to say more so. Yeah, so when you say passive uh sellers, what do you mean by the passive sellers? Like, give us a more in-depth explanation because I know you have experience in this. What do you mean?
Oh, so basically, stop orders or sell orders just sitting there, lying there, waiting to, what you call it, absorb liquidity.
Yeah, it's something even simpler than that. We see blue delta inside the candles when the aggressive buyers are present, they don't break above the
Mm.
level. There's passive buyers present, so they break below. So it's not even about liquidity or anything. It's literally about delta inside the candles, which determine whether you want to go long or short. And this is how key levels are made. This is how entries are done. Accurate entries are done. Okay?
Correct. It's all about the delta.
Absolutely. Delta, key levels, fair value gaps. So ego versus execution. So understanding, so ego is the biggest enemy of execution. And so execution simply comes down to what Mo was saying, right? Mohammed Mullah. Basically, buyers and sellers inside of key levels determine your execution because the market is an auction. Auction are buyers and sellers. Buyers and sellers create the oversupply or the demand for a instrument or stock. There is nothing else that you need to know other than this. Obviously, there's structured processes to get to that point. But what you want to understand, like I just said, is so market is an auction, right? Now, if the market is an auction, it's an auction between buyers and sellers, right? So let me just, it's an auction between buyers and sellers. And so if it's an auction between buyers and sellers, that means you need to read the buyers and sellers, right? So you actually have to read them. And so reading the buyers and sellers creates supply, right? This is basically how markets work, right? Auction, you read the auction through buyers and sellers, and the buyers and sellers create supply and demand. And so if there's an oversupply, right? If there's an oversupply, it means you go short. It means we see lower prices or prices fall. Now here, if there's a higher demand, or I don't know if I can say over demand, but if demand outstrips supply, we will see prices rise. So this is the basic framework you want to kind of take into your trading, right? So the market is an auction. So a lot of people they fail here. A lot of people they fail here. So notice how everything's kind of connected, right? Everything's connected for a reason. Connected, 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 connected. So a lot of people here they mess up because they think the market is about sweeps, or they think it's about, tied into that liquidity. They think it's about structure. They think it's about volume. They think it's about an algorithm. I can't believe that. They think it's about a bot. I had one person try to convince me it's to do with AI. So yeah, it's just an ego check, right? So what we want to do is we want to understand the market is an auction between buyers and sellers, right? It's none of this stuff. It is just the buyers and sellers. Now, what are the buyers and sellers doing? If they create an oversupply, right, prices fall. And so that's what you see over here. Sorry, that's what we saw over here, right? We saw an oversupply because buyers were aggressive, and that's what creates the oversupply. Now, vice versa, if there's a demand, there's a lot more aggressive sellers than buyers. Demand outstrips supply, prices rise. That is how, oop, drop my pen almost. That is how the market works. There's no two ways about it, right? That's how the market works. Maybe try and like maybe take a picture of this or put it into your brain. I mean, this is recorded so you can go back and see it, but definitely you want to ingrain this image into your brain. Now, yeah, so that obviously leads on to ego versus execution. And so candlesticks, Heikin-Ashis, ICT, smart money concepts, EMAs, VWAPs, Elliott waves, even support and resistance and trend lines, right? A lot of those things are execution. A lot of those things are ego through execution, or they're ego instead of real execution. So real execution comes down to pick your levels, understand buyers and sellers, see whether there's an oversupply or over demand, and then go long or short accordingly. That's what this goes that's what we see, that's kind of what I was trying to explain here. Yep. So next we move on to this. So you only really need supply and demand. So this is kind of the next topic. So supply and demand governs the reason why the markets move up or the markets move down. So there is no other reason for markets moving up and down. Like I genuinely cannot think of another way to explain this, right? If there's an oversupply, the passive sellers, as Mo said, drive price down. So this price action, there's a wick over here, 5 minute wick. I think this wick here corresponds to this price action here. So you can see 1 minute, but on the 5 minute it would look like a wick. And so this is the 5 minute wick. And so what you can see is that when there's an oversupply, buyers are aggressive and they're unable to break the level. So the only way, so order flow is kind of the last step, if that makes sense. So this is how you want to see order flow specifically, right? So I get a lot of questions about order flow, right? So let's break this down. So the way order flow actually works is you need to have a key level to begin with. So if your key level is off, uh, then it's not going to work. So once you have a key level, you want to wait for an entry into the key level. And once you see an entry into the key level, what you're then looking for is aggressive buyers, uh, no break above the key level, and that means you go short. Yeah. Or in other words, in the flip side, when you see aggressive sellers and no break higher or no break higher above the level, that means you go long. So what was going on here was a classic absorption of buyers, which created the short. So this is another one to burn into your brain. So let me tell you where people go wrong with this, right? What they'll see is they'll see the aggressive buyers, they'll see no break above the zone, so they'll be like, oh, these aggressive buyers are failing, and then their short fails. And the reason their short failed is because they didn't put the time in to get one right. So there's a reason it goes one, two, and then three. People rush towards three without even waiting for two, or even worse, knowing how to do one. Right? So there is a systematic way to this. Well, I'm just going over the thought process. Today is more of a mindset video. So predicting versus reacting, or ego versus execution. So you can't actually predict any market, right? Because we as retail traders or home day traders, we don't have the ability to compete against multi-billion or even multi-trillion markets. We can't do that. Instead, we can only ride off the backs of the winners, right? We are basically chasing the winners. We have, like that phrase of follow the money is so true. Like it's so true in trading, right? Just follow the money, right? Don't try and think you are the money. Don't try and predict where the money is. Don't try and force where you think the money is going to be. Don't try and think that you can read the money without reading the money, right? Just react, just read where the money is and react to where the money is going. Now, that is easier said than done, and it's simple, not easy. Now, the reason it's not easy is because it's typically ego versus execution. Execution is easy. The problem is, are you going to pick ego or execution? Now, ego comes before execution, even in the dictionary, I think. Should do. Yeah, it does, because it's EG and EX. So ego always comes first, unfortunately, right? And ego comes back to this over here, right? Candlesticks, Heikenashis, ICT, SMC, VWAPs, Elliott waves. A lot of these things is ego before execution, because execution comes down to what I went through here, right? This is how execution works. Market is an auction between buyers and sellers. In fact, let's just go through that one more time because I'm very passionate about this. The market is an auction, right? And when the market is an auction, there are only ever buyers and sellers. And when there are only buyers and sellers, that means that there's either a supply of something, right, in which case you sell, or there is a demand for something, in which case you want to be buying. So the only way you get this right is by number one, understanding it's an auction, knowing how to read the buyers and sellers, and then setting up your key levels. Because you need key levels because supply and demand zones are basically key levels that the market has given you, right? You cannot go out there and predict your key levels, right? Only the market can show you that. So when you look at any of the charts that I share, you will see key levels on the charts. And now it is practically impossible to trade without them. I don't know how people trade without them, long term anyway. Um, yeah, so you want to follow this system. So market is an auction, please understand that. Buyers and sellers are the only thing that drives the auction, right? Or for us, it allows us to read the auction in a way for us to know, are we at supply, go short at the key level, or are we at demand? You want to be going long at the key level, right? It's a very simple and systematic breakdown. The reason traders get this wrong, in my opinion, is because of it's my current argument I'm battling with a lot of traders: ego versus execution. Right? That's the kind of a line I have right here, right? Ego versus execution. Now, being on the right side of ego and execution isn't something that you can do in a day. It's typically something you have to get burnt through first, right? You have to go through the losses. You have to go through the pain. You have to go through. Unfortunately, I often said, I made a video about this. The market rewards idiotic behavior through something called beginner's luck, or I even call it idiotic luck, to be fair, right? You can be an idiot and still do well in the markets because fundamentally, if it's an auction, you're going to be on the right side of the auction more often than not, right? And you don't even need to know it's an auction to know to go long or short and make money. But if you want to make long-term money, then you need to know what the auction is doing. So predicting, reacting, and then the last thing is the market leaves clues. And so key levels, key levels, key levels. The key levels are not something you make or I make. They are something that the market tells you before the sessions even begin. You need to have your key levels on the market before the session even begins. And this is why I talk about pre-market game plans. So a pre-market game plan, you want to ask yourself two basic questions, right? Where is supply? Where is demand? And so the way that I trade is that I have my four levels like this. I will only look to go long and short at these levels. So my game plan is literally, if I go to the screens again, my game plan looks something like this. So I can reveal my game plan to you, right? I think I did it at the start. This is an Asia low here. Uh, here. So I want to see the market come below the Asia low. I want to see price create demand from the footprint charts. I'm not going to predict the demand. The market will tell me, and I will then trade from key level one, key level two, key level three, key level four. I think key level one and two are our best friends for the rest of the week. And yeah, so again, it's about predicting. It's about reacting to what the market has done, not trying to predict on what you think is going to happen. It's a fundamentally different. It's a it's a flawed way of thinking to think that you can come in and predict. You can't, right? Supply is there, demand is there, trade off it accordingly. And so I'm going to finish the entire presentation with this, right? So change your mind forever. I I'm not saying you need to do that today, but hopefully in the long term you can kind of maybe take some value off this and continue to prosper, I guess. So that's kind of the end of the stream. I'm going to stop the recording as well. So